Welcome to Markets Now. I'm Michelle Rook with Rich Nelson with Allendale, and we had a mostly higher close today in grain and livestock futures trade. And Rich, I want to start off talking about wheat, which was the price leader in the grain complex. Was that all corrective buying because we're just coming off of contract lows, or was there some export news to help drive this?
I do think we have this question about Chinese buying off and on, and we've kind of heard these rumors for quite a few days. But I think the general story is maybe a little more agreement about potentially some type of Russia wheat export restriction. Maybe not an outright ban, which was the discussion a couple days ago, but I would suggest that the fact is their November export numbers will be slipping to below last year levels. Probably the same thing for this month. The question for us is with their rising wheat prices, we probably are seeing a tightening Russia domestic market here.
Yeah. And you got to believe we did get some corrective buying or some short covering. I mean, the funds are near record short in these three exchanges, aren't they?
They certainly are. And on top of that, just keep in mind, we hit brand new contract lows here for most of these contracts just 2 days ago. So you can argue maybe a little profit taking a little in the very short term. Also, we have some news that the Indian government's going to continue their food their domestic food program as well for another 5 years in front of us. I think the question for us right now, maybe by the end of this year, we can argue a slightly changed story, at least in the very short term here.
Okay, so we bounced off these contract lows here because we were oversold, but any sustained rally and getting the funds to blow out of their shorts, what would it take, Rich?
Let's be very clear. We've got to fix this U.S. export sales problem. For the past 5 weeks of U.S. export sales have been quite a bit of a problem. The trade discussion here for tomorrow's report really not is going to be too aggressive. So I think the issue for us is, despite the fact we are now a little better priced than some areas in the world, which hasn't been the case in prior months, we're not yet quite seeing consistent sales. So we've got to get this fixed first before we can argue for higher prices here.
And the corn market bouncing off of contract lows here as well today. And obviously, we have seen a lot of liquidation heading into first notice day. So do you think we can stop the bleeding once we get past that date?
I think we can stop the bleeding, at least in the very short term. I think for the corn story, though, the long-term supply issue is still front and center to us. The fact is that this spread pushing from Dec to March, still widening out even further, now 25 cents. It was just 14 cents at the start of November. So I think this market has a large degree of confidence about the U.S. oversupply issue in the long term. So I can't quite say we're going to change things here just yet for the long term here.
Yeah. And when you get these rallies, close to the $5 mark or even, up into resistance, you kind of get farmer selling picking up there too, don't you?
And that might be the case. One thing we do have to recognize, and we have to fully admit, is a lot of farmers do have these bin doors locked up right now. And so far, the market has not exactly responded quite consistently. There's still quite a bit of a basis discrepancy, Western Corn Belt versus East. So I can't quite say we're changing the story on the cash market discussion here just yet either here. So we'll see about that by the end of this month, perhaps.
Yeah, good point. Good point that you make. Soybeans, we ended off of our highs and the product values, a little consolidation there. So was that profit taking? Did we just hit resistance, or is this market looking forward at some of these rain chances in Brazil again?
I do think the soybean market is kind of more or less in a neutral zone right now, a no man's land, so to speak. We're still waiting for the very key yield determination time frame for Brazil, and that's really not until January. We cannot get excited about yield declines during the vegetative growth stage. So we really need to get maybe in that second week of December, looking at those extended forecasts as they're reaching to January before we start making any larger discussions as far as production declines. Maybe 4 or 5% off of trend yields might be the best guess right now. We really can't, though, argue anything serious past that point until maybe another 2 or 3 weeks here.
So in the meantime, some of those production cuts you mentioned are kind of worked into the price already then.
I do think so. Now, keep in mind here, as far as the market focus and when they want to get excited about this, it's probably not going to be, like I said, another 2 or 3 weeks. You've got to get these numbers maybe in that 7, 8, 9% production cut range before the market really wants to say enough is enough. The other issue we got to point out is, we still have a price problem compared with Brazil. That's not fixed. We also have this Mississippi River, which will be moving over the next 2 weeks to levels lower than the 2012 drought low. So we still have some headwinds right now before we can really say a bull market needs to be seen here for this soybean story.
Yeah. And you mentioned exports, and our pace so far this marketing year is like 20% behind where it was last year. And so even though some of these sales have picked up, we're still behind. But do you anticipate China's going to be back in buying more, because we keep hearing those rumors?
I do think there'll be moderate buyers, and I do think that a U.S. rally, which I do expect higher soybean prices, but I think it's going to be more based on psychology as far as weather hits. I'm not quite sure if Chinese buyers are really going to be panicking and going to the U.S. for the long term. So I would argue more for a psychological based rally, perhaps for a few weeks as we go into the later December, early January timeframe. I can't quite say it's going to hold and stick though. If you're a Chinese buyer, you're going to be quite conservative in the very short term here.
You bet. Cattle market, some follow through here today after an explosive update yesterday, limit up in the Jan feeders. Do you think we're confirming a bottom here, Rich?
We need to. Now, keep in mind on a seasonal basis, this break is kind of normal from a seasonal basis time frame. Usually this cattle market cleans out the entire run up for the year and it goes back to prices maybe seen since the prior May. Now, this year's cattle break has been even more than normal, down to prices since last March. But on a seasonal basis, typically this late November, early December break, usually it's a significant buying opportunity as we go into January 1. For this year, I'm not quite sure if we'll have that type of rally back to new contract highs by January 1, but I would suggest we can probably rebuild about half of this break over the next 5 weeks here.
Yeah, and Rich, some of this break has come with some massive fund liquidation. Are they done selling there, you think?
I do think in the very short term. Now on the charts, we haven't quite picked up or we haven't quite cleaned up a lot of the negative business here just yet. 2 days ago, we did leave this intraday gap here from the close. So there's still reason for perhaps one last spike low, maybe clean out some of those chart-based needs. In the grand scheme of things, though, I do think we've done enough damage to this chart right now. We do have some good discounts with, markets implying that cash is still going to break, getting down to maybe 170, 171 for the Southern Plains. So I do think this market probably has maybe a little too much of a discount already priced in right now.
And from a demand perspective, we have seen maybe a little bit of push here from this third quarter GDP number, you think, or at least that gives us a little hope?
I think that's true. Now, keep in mind here, third quarter GDP was revised from the first estimate of 4.9% growth up to 5.2. So good news there, but we all understand the question is right now about this current quarter we're hearing for the fourth quarter. I got to say, though, let's remember over the past 4 years, retail beef prices have advanced 39%. So a U.S. consumer may be having a little pushback. In addition, we've really fixed this first half of next year's supply concern. We won't really have the bull market returning into the second half of next year. So maybe the question is a moderate rally. We can't get too excited in the grand scheme of things right now, though.
And the hog market bouncing off of these new contract lows now. So are we trying to bottom that market as well?
I do think so. And keep in mind this February contract. Let's be very realistic, guys. February futures are actually at a discount to last year's prices. Last year was a big discrepancy as we had that Prop 12 question going on. This February contract is 25% below the last normal year, 2 years ago. So I think the question for us right now is, yes, we're undervalued on February, April, and June futures. The question, though, is when we're kind of finishing up with this discussion about this very sloppy winter low time of year here, though.
Okay, but you feel like we're following the normal seasonals more so this year then, is what you're saying.
Actually, we are. And we cannot disagree with that. The normal seasonal is for a break on these futures until December 17th for futures. I do think we'll have an earlier than normal break or earlier than normal bottom, but how quick we come off these lows is a big question. We do have a gap directly ahead of us on the charts. Let's get that gap filled and then maybe wonder about what's left after that point in the very short term.
Yeah, and the cash index is finally showing a little bit of a turn here too, isn't it, to help?
And that's a very big point. We had these significant losses in the past 3 to 5 days, anywhere from 50 cents to $1.40 in terms of daily cash hog losses. What's positive? Number one, as far as Tuesday's price, that actually was a higher cash hog trade. December futures, which expire in about 13 days, they're now implying that daily cash hog losses will only be 20 cents per day. So this market is changing its attitude and saying that the worst of the worst is behind us. That's a good first step right now.
All right. We have to stop going down before we can go up for sure. Rich Nelson with Allendale. That is Markets Now.